Hi everyone, welcome to this FR topic explainer video. I am your tutor Aleena Kareem. I am an ACCA subject expert for the financial reporting stream of exams. Today we are going to discuss in this topic explainer video the recognition and measurement parts of the conceptual framework. Now this is something very interesting. Recognition and measurement are two words that we listen to very frequently. Why? Because they are there in every standard. Every IAS, every IFRS that we come across, it has a recognition criteria and it has a measurement criteria. So to explain that further, in the conceptual framework also, we have a detailed knowledge of what recognition means and what measurement means. Now, in this case, we are going to start off by recognition and then we will move on to the measurement criteria. So let's start off by seeing what are recognition and measurement. A lot of students make the mistake that they use these words interchangeably, but that is not the case. Recognition is separate and measurement is separate. So in this video, we are going to look at the difference between the two. We are going to see what the importance of these are in your exam from the conceptual framework perspective. But remember, it is so important because every standard has recognition and measurement criteria. So you should know what recognition and measurement mean and what are the rules that are applicable to actually understand how you are going to understand their role in every standard. So let's start off with the recognition part and the measurement part. Both are related to accounting entries. So whenever there is a transaction in a business, because we're talking about financial accounting, so whenever there is going to be a transaction in any business, there is going to be an accounting entry, which is a double entry. And whenever there are double entries, there are elements of accounting involved. So something is going to be debited and something is going to be credited. And what is going to be debited? One element of accounting. What is going to be credited? One element of accounting. They might be the same. They may both be assets. One may be asset, one may be liability, one may be expense, the other may be asset, one may be expense, the other may be liability. But definitely in the double entry, one element of accounting is going to be debited and one element of accounting is going to be credited. So when we talk about recognition and measurement, these criteria tell us what is going to be recognized and how it is going to be recognized. So the what part tells us that recognition, what do we recognize? This will also include at what time the recognition needs to be done. And the how part focuses more on what is going to be the valuation that we are going to allocate to it. So recognition and measurement criteria, they basically tell us in recognition that what double entry should be passed, when it should be passed, so what should be debited, what should be credited, and measurement tells us that how much value should be put in. If we are going to debit the asset, should be debited by 100, should be debited by 120. So the how part and the valuation part is covered in the measurement criteria. But we are going to have further guidance from the conceptual framework. This is a topic explainer video. So I'm not going to teach you the whole topic. For some key definitions, etc., I'm going to refer to the study hub also. We don't have a question debrief involved in this, but the practice material is available in the study hub as well. I'll show them to you in a short while. So it all comes down to this one line: conceptual framework for financial reporting. In 2018, the conceptual framework was revised, and framework acts as the base for all the standards. So the conceptual framework tells us everything about what are the items that can possibly be there in your standards, what can be possibly a recognition criteria, what can be possibly a measurement criteria. All of that is going to be guided through the conceptual framework for financial reporting. Today also, the video that we are covering, we are going to refer to the framework in it. Any point that you find useful, immediately note that down. Something you don't understand in the first term or you want to revise it, go back, rewind it, and you can listen to the video again. But this is very important because this is like the base of all the standards and all the accounting treatments. Now, we come to the elements of financial statements. I was just discussing that what are the elements which are there in financial statements. So whenever we pass the double entry, no matter what kind of business we are talking about, anywhere in the world. So the country does not matter, the type of business does not matter, as long as it is a business and there is a transaction happening in it. It is going to fall under one of the 5 elements of accounting. I'm talking about the debit side. So we have a debit side and we have a credit side. Both items are going to be through some element of accounting. So what exactly are these elements of accounting? The first one is the asset. The other one is the liability. We know these words, we've heard them before. Then we have equity, and we have income, and then we have expense. So any business that you pick up anywhere in the world, the double entry is going to fall within these 5 elements of accounting. So if you know correctly what these elements are and what their movement is related to, you can do the accounting of any entry. Personally, I do not believe in rote learning any kind of double entry. You should know the logic of every kind of double entry. Why? Because when you go in the exam and when you go in the practical field, it's not necessary that you're always going to rely on your memory to remember what was the double entry for a particular accounting treatment. You should know the impacts that are there. If an entry is happening, what is being affected in that? Which element is increasing? Which element is decreasing? So you need to clearly identify these 5 elements of accounting. So any transaction that comes in front of you, you should pick up from it the element of accounting and then see what is increasing. Are both elements increasing? Is one element increasing? The other is decreasing, and automatically the double entry will be made. So don't ever rote learn the double entries. Always remember the logic. My personal teaching philosophy is all about understanding the logic of the accounting treatments. Because if you know the logic, you are going to apply it on any other transaction also. You don't need to just rote learn the entries to handle how the accounting treatments are going to be. So always remember the principles of accounting and remember the logics of the accounting treatments. That will go a long way in your life and in your career also. So you'll remember me when you remember the logic of a double entry. So coming back to this, so these are 5 elements of accounting. Sorry, I'm very passionate about this part, that you should always understand the logic of the things, because if you understand the logic of one accounting treatment, you can replicate it to 200 questions. But if you just try to rote learn the treatment of one question, then ultimately when you move on to the next one, you're going to struggle with it. So understand this and always apply this rule to understand the complete logic. And our life is much easier. We only have 5 elements of accounting. So yes, we have non-current assets and current assets, which are branches of these, but basically it is all going to come down to 5 elements of accounting. So just for a quick overview of their latest definitions, let's move to the study hub. I hope by now you're all familiar with the ACCA study hub. If you go to this, the FR chapter study notes. So in the chapter 2, there is conceptual framework, in which they have covered different parts which are there. And in this, if you see, there are elements of financial statements. So if you go on to the terminology part, you can see it over here that the financial statements, they have overall 5 elements. Asset part is the economic resource. It is a present economic resource and which is controlled and arises as a result of past events. Then in the liability, a present obligation, transfer of economic resource and past events. Equity is the residual interest. And then income and expenses are explained on the basis of the definitions of assets and liabilities. So increase in asset or decrease in liability is going to be income, and like vice versa for expenses. Now you must be thinking, why is Aleena going to elements of accounting for teaching us recognition and measurement? Because where I started from, I'll go back to that When you are talking about the recognition and measurement, you have to pass accounting entries. And these accounting entries are all going to be based on elements of accounting. So you should know exactly what are the elements of accounting to know when and how they are going to be recognized. And we are thankful to Conceptual Framework for telling us all of this. So these are the elements of accounting. Now let's come to recognition. Now, when in 2018 the Conceptual Framework was updated, previously there used to be just a recognition criteria. In 2018, the derecognition part was also included in it. So I've included it in my this short video today also just to quickly give you an overview that how Conceptual Framework is talking about the derecognition criteria also. But let's first start with the recognition part. So what is recognition? Recognition is the process of capturing for inclusion in the statement of financial position or the statement of financial performance, which is P&L, an item that meets the definition of an asset, liability, equity, income or expense. So you see, when I said that first you need to know the elements of accounting, why is that? Because once you know the elements, the recognition criteria tells you how to capture them, how to record them, so that they ultimately are reflected in your statement of financial position and statement of profit or loss. So recognition is that whole process. Now, very importantly, when the Conceptual Framework was updated, the reference for recognition was made with respect to the qualitative characteristics of financial statements. I'm assuming you have already covered them because you've studied them in your financial accounting exam also, on which this exam is building up. So qualitative characteristics, and there were two main or fundamental qualitative characteristics, which are relevance and faithful representation. Now, the Conceptual Framework says that recognition of elements is going to be based on relevance and faithful representation. So they say that items are going to be recognized. Why? Because they are relevant to the decision-making needs of the users. And on the other hand, they also talk about faithful representation. So some company may try to skip a certain accounting treatment by saying that, oh, it's not relevant to our users. However, faithful representation then says that you need to show in your business whatever is actually happening. So you need to show in your financial statements what is actually happening in your business. So these two are made the base for the recognition criteria. So the standard says that the information and the accounting treatment should be relevant and it should faithfully represent what is actually happening in the business. So if we have actually transferred the control of an item, so we are going to record it as a sale. If we are still in negotiation, then recognizing it as a sale would be wrong. It would not faithfully represent what is actually happening in the business. So the recognition criteria is focusing on this. A small change that happened in the recent updation of the Conceptual Framework was that previously there was a very strong probability criteria. When the framework was updated, that probability criteria was removed from the recognition criteria. The reason for it being that there are certain standards where the accounting treatment slightly deviates from it. So some may only allow you recognition when the things are virtually certain. In some cases, there might be slightly more flexibility, that something which is moving more towards possible circumstances that may also be recognized due to the certain dynamics which are involved with that particular accounting treatment. So that criteria has been flexed with respect to recognition. However, this is the process of capturing and it is based on relevance and faithful representation. So what do we say? That whenever something is meeting the definition of an element of accounting and the transaction has, definitely if you're talking about asset and liability, the transaction has already taken in the past. So because you know equity, income and expense, they are based on the definitions of assets and liabilities. So the transactions have already happened in the past. Now, when do we recognize them? When it is relevant and they faithfully present what is actually happening in the business. So recognition is going to be done, and based on that, we are going to pass the double entry. So once again, this one word actually faithful representation also covers everything. So when you say, you, just like I gave the example that you recognize the sale when the control has passed. So that is what that comes under faithful representation. So this provides the basic framework on which now all the standards are being developed. Then we come to the derecognition criteria. So derecognition basically means when you remove an asset or liability from an entity's statement of financial position. It may be full or it may be in part. Now, derecognition, it normally takes place when entity loses control of an item, and in case of, that is for the asset, and for the liability, when they no longer have to pay for it. Someone might waive off the liability. So let's suppose someone had to pay me $1,000 and I said that, I'm just allowing it to not pay, I'm allowing you to not pay that to me, and I'm not going to make any claim on this in future also. Or that person pays me the full amount, and so I don't have any further receivable asset, and for that person there is not going to be any kind of liability which is going to be there further. So when you lose control over a part or full asset, that is when the derecognition takes place. So if I sell off my asset, or just like the example I gave you, I had a receivable from someone and I tell that person that I'm not going to make any further claim. So now this amount is over between us. There is no further receivable that exists. So what does that mean? That my recognized asset, I've committed that now there is going to be no control over it. And the same thing as a liability for that other person, that also has ended, because that person now has no longer a present obligation for all or part of the recognized liability. We have seen this in terms of what we call the impairment of financial assets, or in your basic financial accounting exam, you have talked about receivables expense, or what we call irrecoverable debts also. So in case of irrecoverable debts also, at times the receivable is lost. So now we can't claim further because the company has liquidated from which we were going to receive the amount. So in any such case also, for the payment person, the liability has ended. For the receiving party, the control has ended. Let's suppose I had taken a loan from a bank. I have paid it back. Now there is no further liability. So my liability is going to be derecognized. I had an asset. I had a car. I sold it off. I've legally transferred the papers. So now I don't have any control over it. That is going to be a derecognition. So whenever these things take place, you have to derecognize it, which means you have to remove those elements of accounting from the financial statements. All these things are one more word that has been very strongly emphasized in the conceptual framework is to focus on entity-specific transactions. So we are going to be, all of these criteria are going to be applied on a particular entity that we are focusing on. Now, when we talk about the syllabus linkages and assumed knowledge, so this is the base for all the standards. So this is a topic which is going to be linked with all financial accounting, financial reporting, and strategic business reporting exams. So knowledge of financial accounting, financial reporting, SPR, everything is going to be there. And even for the next papers like audit and assurance exams, this is all going to be applicable. In case of syllabus reference also, the recognition and measurement criteria, you can see them that the syllabus itself says that you have to define what recognition means, discuss the criteria, apply recognition criteria to assets, liabilities, incomes, and expenses. Then talk about the measurement criteria. We're going to discuss this shortly. Discuss the advantages and disadvantages of historic cost, and discuss whether the use of current value of accounting fully addresses the issues related to historic cost accounting. Now we come to the measurement part. To give you a quick overview, when you talk about the measurement basis, one thing is for sure, the word measure. What does that mean? We are trying to calculate the value. We are trying to put the value on something. Now, in this case also, there are two categories in which the measurement of elements of accounting can be done. So we are sure that we identify what the elements of accounting are. Then we pass their entries based on what criteria? The duality concept that we have studied, the debit and credit rules that we have studied. I didn't go into their details, but in any transaction, you pick up the elements of accounting, then you see whether they are relevant and they are faithfully representing what is happening in the business. When you apply that criteria, automatically your double entry is going to be made. So once that double entry is made, so I've decided that I'm going to, let's suppose, debit my property, plant and equipment, and I'm going to credit my cash, then the next question is that by what value do I pass this double entry? And for that purpose, we see the measurement basis. So the conceptual framework, it gives you a choice of two types of measurement basis, which is historic cost measurement basis and current value measurement basis. In case of historic cost measurement basis, we talk about that historic cost measures to provide the information about elements that is derived from the historical price of transaction or event that gave rise to the item being considered for measurement. Now, let me explain these 2 points quickly to you. When you say that the value is derived from the historic price, remember, we are not saying that the item is going to remain at its historic price. Why? Because if you talk about property, plant and equipment, then you, let's suppose, purchased an item of plant for $5,000, let's suppose 8 years ago. Now, historic cost concept means that today, the carrying value that you calculate of that item, the depreciation should be charged on the historic cost. So the carrying value is going to be cost less accumulated depreciation. However, that depreciation is going to be based on the value that you recognized as a cost in the very first place. So let's suppose if your item was for 5,000 and till date, your depreciation is of 3,000 accumulated depreciation. So that's going to be 5,000 minus 3,000. Your carrying value is going to be 2,000. So please do remember that historical cost measurement basis does not mean that the plant is going to remain at 5,000. Rather, it means that its carrying value is going to be calculated by applying the depreciation methodology on the cost of that particular item, the historic cost. And the second part of this definition, where we say that the event that gave rise to the item that is being considered. So, for example, we've seen in IS 40 that at times there is a transfer of asset from one standard to the other. So we saw in that case also that you need to calculate at times the fair value of the item or the revalued value of the item at the date of transfer. In case of IS 38 also, in case of IS 16 also, at times we don't pay cash for the item. We do an exchange of assets, and in that case also we use the fair value of asset. So whatever value was there at the time when that asset became a part of our business, that is going to be used, and going forward the measurement is going to be done accordingly. Then the second part over here is the current value measurement basis. This is different from the historic cost. It says that current value measures provide monetary information about the elements using information updated to reflect conditions at the measurement date. Now, when we talk about the different kinds of basis, please remember that one model is that we take the historic cost and we apply the depreciation on it. But definitely there are advantages of that system, and then there is criticism of that system also. We'll discuss it shortly. But as a result of the criticism that was there on the historic cost model, the concept of current value measurement basis was introduced. So when we talk about the current value measurement basis, it says that the measurement bases are based on the value at the measurement date. So if you are valuing an asset today or a liability today, this is the value at which it is going to be recognized. So we have different options in this. We have fair value, we have value in use, fulfillment value. These two are basically giving the two sides of the same thing, value in use for the asset and fulfillment value for the liability and the current cost. So the fair value we calculated using the criteria for IFRS 13, which means that it is a transaction which is an orderly transaction between market participants at the measurement date. The value in use, or what we call the fulfillment value, is defined as an entity-specific value, and it remains at the present value of cash flows that an entity expects to derive from the continuing use of asset and its ultimate disposal. So when we are talking about this criteria can be applied in case of financial instruments also. So if you're talking about the assets or liabilities which are held at amortized cost model, we adjust them for the interest, for the cash paid or received, and then we calculate their value. So that is something which is using the time value of money concept also, and that is going to be adjusted to calculate the value at the measurement date. And then lastly, we have the current cost. Current cost is basically different from the first two categories that we discussed. It is basically an entry value. It is the value in which the entity would acquire the asset or incur the liability at current market prices, whereas fair value and value in use, they are basically exit values. So in them, we see what will we receive or what will we have to pay to finish off these items. And in case of current cost, we see it other way around, that what will we do or what will we have to pay if we have to purchase this asset, similar asset today, or we have to give off a similar liability today. So how do companies choose between them? It totally depends on the qualitative characteristics. Once again, it all comes down to the relevance and how items are actually calculated and how they are going to best fulfill the faithful representation criteria while meeting the relevance criteria, that they fulfill the needs of the users. In case of historic cost accounting, just like we discussed, these are the items at which it was historically recorded. There are certain advantages of this system. It's easier to understand. Anyone can understand that this item was purchased for 5,000 8 years ago. The figures are objective, reliable, and verifiable. You have in writing maybe contracts to prove that value. Comparability is higher because year on year basis we have the same kind of figures, and there is a lesser possibility of manipulation in them. However, there are some disadvantages also. In some cases where especially the market prices are volatile, the carrying value in the financial statements may be substantially different from the market value. And that is something which needs to be sorted. It normally ignores the inflation effect because we calculated at the value at which it was there so many years ago, and now we are charging the depreciation on the same thing. So inflation is nowhere accounted for. The value of the asset is still showing the value at which it was there, let's suppose 5 years ago or 8 years ago. The physical capital is not maintained. The ratios can be distorted. So combining these 2 points, once again, when your overall, you cannot understand that at what value your asset is today. So in the market also, when you give the picture of your performance, the people will not be able to actually understand the strength of your capital or the strength of your company. So in case of ratios also, they are going to be distorted because they are using figures which were of way in past. So let's suppose if we are talking about asset turnover. So if the assets are of the value which was there, let's suppose 8 years ago, and the sales we are taking are of today, so they are not like with like, and the ratios are not going to be correct then. Then gain or loss of inflation on monetary items is ignored, just like we discussed. The inflation part is not there, and overall the monetary items impact gain or loss, everything is lost. And once again, on one hand we say that comparability is there because the same figures are being used. However, on the other hand, they are not exactly the same accurate because they are not being restated for inflation, whereas all the other items, so sales, etc., everything which is happening new in this year, that's going to be at the current values. However, these figures are going to be at the past values. So in case of exam application, I don't need to tell, they're going to be applied everywhere because all accounting treatments are recognized and measured, and then their entries are passed. So for the practice of past exam papers, I would say for all the accounting treatments that you do now on, always see their logics. When you're solving the question, see the requirements carefully, extract the data very carefully, whether you're talking about an objective test question or an OT case question, or you're talking about a constructed response question. in them, identify things carefully, see the data which is relevant to your question, see the marking scheme, and always have the conceptual understanding. And to get all of that, you need to do a lot of practice. So please practice a lot. When you're doing the practice, do in writing practice, whether you're talking about OTs, OT cases. Just don't, randomly click and try your luck. Solve the questions, do the practice properly for constructive response questions also. Understand the logic, apply these criteria that are there, and then see how you can manage time and how you are going to mark yourself on them. So this is all from my side for the recognition and measurement overview. I hope you found this video useful, and you'll come back to it again in case you face any issue. Thank you.